Hey everyone, welcome in to another daily editorial here on the KE Report. We are chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, big picture. Look, we can talk about the day-to-day or week-to-week moves in the precious metals or in the markets or in the dollar all we want, but right now it does seem like, and what we're hearing from more and more people is that stuff could be range bound. Markets broadly could be range bound for the next few months. Who knows? Maybe through the rest of this year. That's going hand in hand with a lot of people saying, well, maybe we are going to get a soft landing. Maybe this upcoming recession, or the recession that it seems like everyone's been waiting for, might not be as bad as some people think. It's impossible to forecast what is going to happen in the future, but in your eyes, when it comes to putting a more sustainable trend in place for the metals or even for the markets, what do you think matters, especially when it ties in with that whole recession narrative that everybody still continues to talk about and read about?
Okay, well, quite simply, Corey, what matters is the economy going to have a soft landing or a very, very mild recession where you have 2 quarters where it's negative and yes, it's a recession, but it's very mild and it's more of a soft landing. So you have that scenario, and then you have the scenario where a real recession hits and the Fed, and when that happens, inflation metrics are going to plunge, and then the narrative is going to change from the Fed has to tighten more, they're going to be holding or positive, whatever. It changes from that to, okay, they're going to have to cut rates here, and we're going to have to look at more fiscal stimulus coming in. So to me, that's really the big question if we're looking at the rest of the year. And as far as the timing, if you look at the history of all these yield curve inversions and you look at the average and median time of when they invert and when the recession actually hits, you're looking at the absolute earliest, like April or May. But in most cases, the median and average time of those inversions gives you a forecast of July, August, and that period. So just the fact that we haven't, and I'm a little guilty of this in recent months, but the fact that the recession hasn't hit yet, or even if it doesn't hit for another 3 or 4 months, that doesn't mean that it's not going to hit later on, that there's no landing and we've safely escaped that threat. So you look at this data, look at the LEIs. The LEIs have come down so much, and that indicates there's going to be a recession. And all the soft landings, the LEIs just came down a hair. So the data is telling you there's going to be a recession. And in addition to that, yes, the Fed has tightened policy, but how long has the economy in the financial sector had to deal with 4% rates or even 3.5% rates? I mean, I think raising rates from 0 to 2 or 2.5 or even 3, it doesn't quite do that much. It really needs time to hit. So I think, again, you look at this timing, you give it another 3, 4, or 5 months. That's more time where these high rates of 4+% are really going to start to make an impact. If you look at in recent months, lending standards have really started to tighten up. So you look at all these things. There's a severe risk of a recession hitting in the second half of the year, probably sometime in the summer. And again, that's just the big question. If you think it's going to be really, really mild and more close to a soft landing, then it makes sense where you want to be bullish on conventional stocks and also commodities. However, if you think a real recession is going to hit, it's going to be a hard landing, and the Fed is going to have to completely reverse policy. That's the scenario where you want to be in precious metals. Then it's going to lead to gold breaking out and making a huge run much higher in 2024 and 2025 and that sort of thing. So I think that's really the key question. And so the fact that the recession hasn't hit yet, that's kind of muddying the thought process right now, where people can say, oh, well, the economy, it looks okay, might be strengthening a little bit more here. Unemployment is still good. There's growth, and the energy stocks look good, and China might be coming on. I think I want to own copper I think it's given the macro. I think I think there's still a lot of risk of owning those things just because of the timing, because the recession hasn't even come yet. So looking at, I mean, of course, I am a gold bug, so I'm guilty of this. I tend to be bullish on gold at the expense of other things. But if you look at these factors and you just look at kind of the macro landscape and intermarket analysis and when you get late into a cycle and go into a recession, what performs best? It's precious metals. So for me, I think there's going to be a real recession hitting later in the year, and that precious metals are going to be the immediate beneficiary. I think for the other commodities, it's you don't want to own them this year. I wouldn't even think about them until next year, honestly.
Well, Jordan, the truth is that really nobody knows what's going to happen as this year plays out. There are economists that are all over the map on this. Some people are saying that we already had the worst of it last year when the markets corrected, when we had the 2 negative quarters of GDP. But there's other economists saying, hey, we could have a double dip recession where that was the first dip. We have this little lull here where things look better. The jobs data looks better. The retail sales looks better. Some of the other metrics that have come in from all of the jobs reports look like the labor markets are better, but then it could dip down and do that double dip. And that would be the worst part of the recession would be the second part. There's also people saying that, yeah, like you said, there'll be no landing and that we're just going to keep on trucking higher. We're in a new bull market in equities and the economy is fine. So in light of all that uncertainty, we don't really know how it's going to play out. How are you dealing with the short to medium term? Are you just waiting for some more economic data to come in where you can kind of look at the ratio charts, the gold versus the S&P, or are you just looking at technical levels to do some short-term trading? How are you dealing with the short to medium term since we're waiting to see how this is going to play out later in the year?
Well, I think the short to medium term is tough for precious metals because in the very short term here, the narrative is the one that you're talking about. It's a no landing narrative. It's the Fed has to be higher for longer. So bond yields have been moving higher. The market is pricing in a much tighter Fed over the coming months, and so that has hit precious metals. And so I do think over the short to medium term, precious metals could struggle. In the very, very short term, I will say precious metals are really oversold. The stocks are really oversold. So I do see a rebound, but I do see risk that gold could fall into the 1700s, maybe even the low 1700s at worst. I mean, I could be wrong about that, but I think for me, the best strategy is if I'm right and gold is going to lose that important support at 1800, when it loses that support, that's the time I want to get, much closer to putting cash to work. I'm reevaluating all my favorite stocks and really looking at which of these companies have the best combination of value and the best highest margin assets. And so that's what I'm really looking for. And we'll see how some of these companies trade over the next couple months. And I think that if gold does lose 1800, maybe even the highest quality stocks with these high margin deposits, even those can sell off some. But I think if you own those, then you're going to be able to ride out the remainder of this correction in precious metals. And at the same time, I do think things that are more closer to being optionality plays or, huge development projects that require $1 billion in CapEx and hundreds of millions and that sort of thing. I'm really avoiding those. I would avoid those until it looks like, the macro is turning in gold's favor and, gold's due for a sustained move higher. So that's my thought process over the next, 2-3 months or so.
Jordan, can you pull up a GDX chart for us? Because it's been a roller coaster ride to start this year. January, GDX just kept moving higher. And in February, it's rolled over and gone almost straight down. It's been down 12 of the last 14 trading days. GDX is down almost 14% just this month. And as you said, look, on short-term charts, it has gotten oversold, and it got oversold in a hurry because of this pretty quick drop here. Now, GDX is sitting right on this 200-day moving average. It's sliced through a lot of the other moving averages that I follow. It's hugging the lower Bollinger Band. Where is the next stopping point for GDX? How do you take into account this roller coaster ride so far this year?
Well, to me, it matches up with the macro analysis, at least my view, that we're going to see a tighter Fed than we thought, at least, pre-February. And because of that, it doesn't, the market, I think, is maybe pricing in one rate cut at the very end of the year. So that's just too far away for gold and gold stocks in the market to really care. In the very short term, here's one stat. I looked at GDXJ coming into the week. You had 0% of the stocks trading above the 20-day, only 8% trading above the 50-day. So when you're in a downtrend and you see those figures, you do get some kind of bounce. So I do think the gold stocks are really ripe for a short-term bounce here. I mean, looking at the other
bull market action though, Jordan? Sorry to interrupt you, but when we do see a sector get that washed out, does it kind of throw a bit of cold water on that bull market narrative?
Yeah, I mean, we're not in a bull market yet. I mean, anybody who's saying that is just incorrect. I mean, granted, there was probably when the market was moving up, it looked like we could be moving into a bull market, but we're really not yet. And looking at if you're looking at just look at the slope of the 200-day moving average. If you're looking at silver or the miners, the 200-day moving average is sloping down. So that's not a bull market yet. And at the same time, I mean, looking at gold, we're not going to be in a new real bull market until gold breaks above 2,000 and 2,100. That doesn't mean you can't make money on a few of the swings, but yes, we're not in a bull market yet. I mean, I do think we'll be going into one probably in the summer or a little later, but that aside, we're not in a bull market yet. So it's wrong for anyone to call this a bull market. It's not bull market action. In fact, I was curious because when this correction started, you had the big gap down, and that's what we've seen over the last 2.5 years. You've seen the miners have rallied, and then they put in a peak, and then within a couple of days they had this nasty gap down, and they kept declining. And I was just curious. I looked at 2018 and that move into 2019, and then that correction that was pretty mild. And during that mild correction, there was no gap down. So that was more bull market action then. But anyway, circling back to the key levels with GDXJ, I would say, looking at, maybe 32, 31. I mean, there is some support there, but I'm not that concerned about levels. I'm more concerned with the macro and, looking over the coming months and, potentially anticipating that, the economy could be moving closer to a recession. And so in that scenario where the macro looks like it's turning more favorable for precious metals, then it's not going to bother me, whether GDXJ falls to, 28 or 31 or 30. That to me isn't really that significant. It's more of the macro that's behind that. I do think bigger picture though, that for, GDXJ and the miners, I do think at the very worst, you could see some kind of double bottom here, or maybe in the middle you see some kind of higher low. I do think that's what's setting up over the next, call it 3 or 4 months, is that they're going to make some kind of a higher low here, and maybe it looks like a double bottom from a bird's eye view. But that's something I'm anticipating as we get into the spring and summer.
Okay. Hey, a higher low would be great for, let's say, GDX, because it's been over 2 years of lower lows. So there's still a lot of room down to that 2116 level that would be a higher low. Boy, oh boy, if it breaks below that, then I'm sure not many investors that listen to this show would be very happy. But hey, that's a good level just to big picture look for. Higher low. That's what we are looking for in GDX. It's been a nice run, but boy, oh boy, this month has been pretty tough as well. Jordan, thank you as always for your time. Interesting to hear your outlook for the charts, but then also a bit more of the focus being on the macro outlook. Thanks for your time, Jordan. We'll chat next week.